Hello, listeners. My name is Charles Scott. The name of this program is called Can We Talk? We are a program that gives you informative information to maybe help you with some of your day-to-day decisions. We talk about current events. We talk about events that are happening around the world. But more importantly, we talk about some of the things that might affect your life locally. Can We Talk? We are actually streamed throughout the United States. But today I want to talk locally to some of the listeners and some of the viewers out there about a subject that I had started talking to you about last week, which is credit. So sit down for a little while, listen to this informative information. We're going to sort of continue on about some of the topics that we talked about last week. Again, my name is Charles Scott. I am the broker and owner of Tri-State Realty. And what I've found is that in my dealings with customers and clients, that credit is a big factor of everything that we do in life and everything that we want to accomplish and buy or sell or even get an apartment, insurance, whatever it may be. Credit is a big factor in that. So that's why I want to gear some of my talk today about what you need to do to inform yourself as far as how you can improve your credit, but more importantly, how credit works. Because what good is having a big high credit score if you don't know how it fits in with the rest of the being as far as buying something or selling something or how they rate you. So today, last week I sort of talked about some of the things that you could do to get copies of your credit report, some of the things that you could do to correct on your credit report. Today I want to talk a little bit about what you can do as far as improving not only your credit score, but ways of doing it without having to spend a lot of money. You know, there are agencies out there that charge you quite a bit of money to improve your credit score, but a lot of these things, as I said in the last week or so, you can do these things on your own. And I'm going to give you about 10 tips today as to things that you can do which are effortless that will improve that particular credit score. And I want to start out with number one. It's called piggybacking. You probably haven't heard of that term, but you know, it used to be widely used a lot. But piggybacking is where you take a person who has good credit. It could be a relative, it could be a friend. You know, in most cases, a family member, a parent, and a child. And you, that parent or that child or whoever that other person is, adds you onto their credit card. And it's like, you know, piggybacking, you know, you get a ride on somebody's back. So you're able to be added on to someone else's credit card. And that's a widely accepted thing that happens. And I did it in my family, where you add someone onto your credit card. Now you may say, well, that person's going to take the credit card and go out and spend, if they haven't been managing their credit or if they haven't done anything to build up the credit, then they may take the credit card and go out and build it up. Well, there's an easy way to eliminate that is because you hold on to the credit card. So what you do is you apply for a credit card, or if you already have a credit card, you just add another member. The credit card company, they don't care, they don't check anything, and they add that person onto your credit card. Now, as you charge and as you pay back your bills, what happens is that it gets reported to the credit bureau. But also it will get reported in the name of the user, the other person who's added onto the credit card. So that, in fact, your good credit is helping that person build up good credit. You don't have to worry about the person going out and using the card because you haven't given the person the card. You've actually, only thing you've done is added that person onto your credit card. So that's a way of improving the credit of that particular person. And you can check periodically and see basically how the credit is going. You're paying your bills off, your balance is going down. And so therefore, it's a way of you being able to control the situation but at the same time increasing the credit of the other individual. A lot of parents even do that for their children that are in college. And in that particular case, they may even give them a credit card to use. And if you feel as though, you can trust that particular person, you can even give them a credit card because they have the card, but you're the primary user. Remember one thing, if they do not pay for the items that they charge, you are ultimately and initially responsible for that particular bill. So be careful as far as handing out the card to just anyone or a friend that's going to possibly use that card. Now, so that's one way of increasing the person's credit who has not built up a lot of credit. Sometimes husbands do it for their wives, the wives can do it for their husbands. So it's pretty common thing that sometimes people don't realize that can be done. The other thing you can do to increase your credit score, first, I think last week I explained to you how credit works. There's 3 credit bureaus, TransUnion, Experian, and Equifax. One of the things that they rate you on is how much available credit you have and how much credit you use. For example, if you have a credit card and that credit card has a $1,000 limit on it, and you charge $900 on that credit card, then your credit score is going to go down. And that's because they feel as though you need that credit card to survive. You're only paying the minimum amount due every month. So therefore, they're saying this person really needs this credit card. Without the credit card, this person wouldn't be able to survive. So they're going to give you a lower score to limit you from getting enough credit to bury yourself in debt. So you don't want to go over, let's say, 30% of the amount of the credit on the card. So if you have a $1,000 credit card, try to keep it down to about $300. And then you charge and then you pay. You charge and then you pay. But don't go over that 30% limit. So here's a way to increase your credit and at the same time not pay down a lot of the debt. So you're saying, how can I not pay down the debt and increase the credit? Well, remember, the credit rating companies are computers. The computer only works by analyzing information. So let's say you have a $1,000 credit card and you go out and you charge $500 on that credit card. So now you're at 50% of the available debt or credit. So it's a 50% ratio. Well, that's not good because you want to keep it at 30%. And you owe, let's say, $500, you got a $1,000 limit. So here's a thing that you can do. Increase the amount of spending on your credit card from $1,000 to $2,000. In other words, you still owe $500, but instead of having a $1,000 card now, you have a $2,000 card. So what's that do to the computer? The computer is saying, okay, this person has a $2,000 card and they owe $500. So therefore, the amount of debt that they owe is 25%. So now you're good. All you've done is made a phone call and you've gone from 50% debt ratio to a 25% debt ratio because you increased the amount of available credit by making a phone call and telling them that you want to go from 1,000 up to 2,000. So that way, guess what? Your score goes up. And what did you do? You made a phone call. You didn't pay anything down on the credit. You left it at the $500, but you increased your available money that you could borrow on that particular credit card. So that's another way of doing it. But now also remember, just because you did that, make sure that you make your regular payments and get even that $500 down. So now that's going to increase your credit score even more. Remember, most people that they say they have bad credit, it's usually around 580, 590. And to buy a house, you need 620 or 640. So you don't need a tremendous amount of points to boost in order to qualify for certain things. But you have to know how to get those points based and boost them up, or you're going to stay in the same rut that you're already in. So every little point counts. So if you get another 10 points here, 20 points here, 30 points there, and they keep adding up, the next thing you know, you've got 100 points added onto your credit score. So these are some of the things that you want to do. The other thing I want to warn people about is this, and sometimes you can't help it, but let's say you have a light bill. You know, the public utilities, light bill, you've got, United Illuminating, you've got Eversource. You have a lot of these light companies. Now, a lot of people, unfortunately, through no fault of their own, the pandemic has come in, and so a lot of people are on payment plans, or they're applying for payment plans. But remember one thing, they report to the credit bureau. A lot of people don't realize that the public utility companies, the light companies, they report to the credit bureaus, and that goes on your credit report. So let's say you owe, say $1,000 again. You owe $1,000 to the light company. So you go in and you get an agreement with them to pay an extra $100 every month until that light bill is paid off. And this I see a lot that happens, and you make that arrangement to pay $100 a month. So every month now you're paying $100 on your light bill, in addition to the other amount that you owe. So as far as you're concerned, you got good credit. You're paying on time. Your agreement is being paid on time. But guess what? The light company is not reporting to the credit bureau that you're on time, because you still owe them a balance, and you're paying on the balance. Even though you're paying on the current amount, you're still paying off a debt that is behind. So until the entire thing is paid off, including your present bill and the balance, they're still going to report to the credit bureau that you are behind on your bill. So if it takes you a year to pay off the old bill, then for 1 year, they're still reporting you as being delinquent, even though you consider yourself paying on time for that current bill. And sometimes people don't realize that, because sometimes you may get the money and be able to pay off the bill, but you say, oh, why pay it off when I can just pay monthly? And they're still, looking at me as good credit. That's not true. Even though you're paying it on time, they're not reporting as everything being paid on time. So just want to let you know that that's one of the things that you have to worry about and be considerate about. There's other things too. Let's say, for example, you want to build up your credit. A good way of building up your credit is through a credit union. Many people are not able to borrow money through banks or mortgage companies or whatever it may be, but they are able to access money from their credit union. The reason why a credit union will be more lenient with you is because the credit union, they look at your job history. So if you've been working at a company for 5 years, 10 years, or whatever it may be, the credit union is more apt to give you a loan because they know that it's coming right out of your pay. So it comes out of your pay, goes into the credit union. Plus you may have a savings account at the credit union too, and that helps. So it's a lot easier to get a loan from the credit union than to go to a normal bank or to any other source. So that's another way of building up your credit, to deal with a credit union. When you're talking about credit unions too, usually their interest rate is lower than a normal interest rate. Let's say, for example, you want to buy a car. If you want to buy a car, let's say the car costs $25,000. If you go into the dealer, well, the dealer gets a kickback, whoever he places you with in a lot of situations. You go in to see that dealer, and that dealer will say, okay, let me go talk to the finance manager. So they go in, they talk to the finance manager, and they come back and say, oh, your interest rate's going to be 15%. because of your credit. Well, a lot of times when they say, oh, I'm going to go into the talk to the credit manager, you figure, well, oh, my credit's not that good. I hope I can get this car. Hopefully they can work with me. And they come back and they say, oh, congratulations, we were able to get someone to accept your car loan. And in many cases now, they'll do it themselves. You'll see advertisements now where a lot of these car companies will say, we finance, no one rejected. You know, if you got $99 and a pay stub and been on the job for 3 months, you're automatically qualified. So they're financing the car themselves. But, you know, they're charging you 20% interest too. So basically, you know, you paid 3 times as much for the car. The car sometimes is falling apart before you even finish paying for it. But they're financing it, so that's all you care about at the point, is you're riding out in a brand new car, your friends are going to see you, you're happy as can be. You know, that $20,000 car might cost you $40,000 in the long run, but right now you don't care. It feels good, it's comfortable, it's shiny. But, you know, as far as finances, that's not a good deal. It's not a good deal at all, because now all of that extra money that you are going to be making could have been going in the bank, and you could have gone out and got yourself a nice little used car. And not only is it going to be all that extra money you're going to be making, you're going to need an extra job just to pay for the car. So now, you know, you're not going to have too much time to ride around in the car, because that extra job, when you get out of one job, you're headed to the part-time. I hear so many people say, I'm going to my part-time job because I need to make my car payment. That part-time job pays for the car. Well, while you're doing all this working, the car is just sitting there depreciating. You drive it off the lot, costs you $25,000. As soon as you drive it off the lot, it's worth $15,000 if you went back and traded it in. So that's not a good, you know, financial deal. And then I hear a lot of people say, I say, why did you buy the new car? You want to buy a house? Oh, I needed a way to get to work. Well, you didn't have to buy a new car to get to work, you know. Go drive around, make a deal, look for some used cars, find a person, a private owner, you know, get a 10-year-old car, something like that that's costing you maybe $6,000, $7,000. You know, with the stimulus money and with your income tax, you might even be able to pay it off in full and have no car payment versus a $40,000 car payment with interest. This is how you create wealth. This is how you get ahead. You say, how do other people get ahead? Well, they don't constantly buy new cars and pay a lot of interest and a lot of debt. And the other thing you can do is, if you're looking to buy that car, after you figure out how much the car is going to cost you, go to your credit union and let them give you the money to buy the car, and now you owe the credit union. So the credit union, the interest might be 8%, might be as low as 4%, 6%, whatever it may be, not 20%. You know, you might have to fill out some more paperwork, but then again, the credit union is going to give you the money because they feel as though you're working there. Like you said, why'd you want to buy the car? To get to work. Well, hey, what better way than go to the credit union to buy the car to get to work? Because as soon as you go into work in the credit union, those are the things they want to hear. They know that you're going to take that money from work and pay off the car. So I'm just giving you some things to think about. These are things that you know, buying a car, buying big ticket items, it's an emotional thing that people get wrapped up into, because they feel as though, oh, I can never own this, I can never own that. Then when they have the ability to get it, they feel as though I'm entitled to it. I work hard, I'm entitled to get this. But don't let that temporary happiness turn into misery when you start looking at those payments and start thinking it's not free. Anything that comes that easy, later on is when you make those payments. And if you, and now they've even extended the payments, so you could pay for the car for 6 years. Used to be 3 years, then it was 4, then it was 5, now 6. You know, 6 years later, how much is the car worth? 6 years later, how many dents does it have in it? Have you had an accident? Look at the cost of the insurance. Look at the cost of the taxes. People don't figure out the total cost. You're buying a car, costs $25,000, $30,000, $40,000. Now, because it's new, you got to have full insurance. Before you had a clunker, you had an old car, all you needed was liability, so the liability only cost you, what liability cost you? Maybe around $600 a year. Now you got a new car, you got to have collision, you got to have comprehensive, you got to have fire, theft, vandalism, all those coverages on there. Now instead of you paying $50 a month for insurance, you're paying $150, $200 a month for insurance and the car payment. So now you're up to $500, $600 a month paying for that car. And you're doing this all the way up until the car is paid for, because you can't take the insurance off until the car is paid for. So you figure out that. Look at another $200 to $300 a month for insurance. That comes to $2,400, $3,000 a year. $3,000 a year for 6 years. Even if it's 5 years, that's $15,000 just for the insurance, not including the other $30, $40 for the car. So now you've actually spent like $50,000 for a car, and all in that period. Imagine if you had just got a used car, paid off your bills, got good credit, and bought yourself a house. Where are you going to be at 5 years later? Versus now, you still got the car, you don't have the house, and you're still renting on top of it. So you see, it's a matter of how wisely do you spend your money. And it's not a rocket scientist situation. It's not something that you really got to go to college to figure out. It's simple math. You sit down and you say to yourself, you know, I'm just going to get a used car, go to work, save my money, pay off my bills, build up my credit. And then great things start to happen versus, you know, buying a new car to ride around. And, you know, why do most people buy a new car, a big shiny car? For their friends, not for themselves. The other car is going to get you the same place that the new car will. Maybe the other car will break down a little bit more often, but then again, there's a lot of mechanics out there too. You're not going to buy a clunker. You're going to buy a car that's going to be in halfway decent that will get you back and forth to work. Because when you buy the brand new car, you're going to be working to pay it off, and you're not going to have time to ride it around in the first place. So these are some of the things that I wanted to tell you about. The other thing too is that if you have, many of you that have maybe credit card debt, and you want to try to figure out how to get out of that credit card debt, every now and then you will get a credit card company that will send you a credit card that will say, use our credit card to pay off your other credit cards. And for the first year, you'll have 0% interest as long as you make the payments on time. You know, that's a good deal. Let's say, for example, you have 4 credit cards that are charging you 18, 20% interest. And let's say you got $2,000 on each one of them. Now, you could take one credit card and put all of those credit cards onto that one credit card, or at least some of those credit cards, you pay them off with the other credit card. Now, it's easier than you think, because the credit card company that's going to give you money to pay off the other credit cards, they don't really see it as a risk, because you're already making the payments anyway. You're already paying 5 credit cards, so instead of paying 5 credit cards, you pay 1 credit card. And on top of that, it makes it a lot easier for you. You're not paying the high interest rates on all the cards. Let's say you're paying $25 on each one of those credit cards. So that's $100 right there. And let's say you're paying $25 on the other credit card. So that's $125. And that's just the minimum payments. So, and that's low. You know, normally it's a lot higher than that. It's usually like, and matter of fact, let's go up a little, because $25 on the credit cards isn't getting you anywhere. So let's say you're paying $50 on each one of those 4 credit cards. So now you're up to $200 that you're paying for those 4 credit cards. And you're paying on the other credit card. So now, by not having to pay on those 4 credit cards, you're going to free up $200 a month. But you still got to pay for the main one, because that main one paid off the other ones. But let's say that credit card, the main one, now you're only paying $100 a month. So what you've just done is you've just freed up $125 a month. And you haven't spent a penny. It's just how you look at things, how you create wealth. How do you maneuver things around for your benefit? And not many people are going to tell you what I'm telling you, especially your credit card companies, because they love it the way it is. No one's going to tell you anything that's going to not benefit them. They want and they encourage you to keep the credit cards. They want to see you make those payments. I'm just showing you simple things that you can do, and it's not costing you any money at all. It's just a way of being able to see and look down, and it's what do they call it, no-brainer. You take that one credit card, pay off the other credit cards. The whole secret here, though, is this. Don't get fooled into thinking you got all of this, ready-built equity and wealth just because now the credit card's down, it's time for me to go back out and charge it up again. That's where the mistake comes in. And one of the things that peeves me off more than anything else is when people say, oh, I cut up my credit cards. They get me in trouble. How's a credit card get you in trouble? You get yourself in trouble. The credit card doesn't get you in trouble. The credit card is not a living, breathing person that goes out and charges stuff and hands it to you and now you're in trouble. No. It always upsets me that I cut them all up. You just defeated the purpose, because the purpose of building credit is by having history. They want to go back and see how long have you been paying on this card? How long have you been in good standings? So when you cut up all your cards, that's the last thing you want to do. Pay them down, but keep them and use them a little bit. Don't let the credit card control you. You control the credit card. You're in charge. Don't blame a piece of plastic for your future. So I hope I've been able to give you some information. As I said, it doesn't cost you anything to do the things that I said. It's just a different way of looking at things. That's why we're talking, and that's why we have this program, Can We Talk? So we can give you some information to help you, and share this information with your friends, and be able to tell them some of the things and have them tune in to see Can We Talk. Until next week, God bless. Thank you. Shalom.